So remember, we're looking at the risk and uncertainty involved in investment appraisal. Risk is numbers, uncertainty, the amount of time, the longer, the more uncertain things are. Okay, and we looked at sensitivity analysis, which was MPV over the PV of the item that you were looking at. The smaller it is, the more sensitive it is, the more risky it is. Well, another way you can deal with risk is this, having a look at simulations. And what this does is you use a computer to say, well, what if this happens? What if that happens? What if the other happens? Just like a computer does when it's playing chess. It can now beat a human because what it does, it generates all the different options. And that's what simulation will do for a business, for a project. It will look at, well, what if sales went down by 10%? What would happen? What if blah, 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 okay? And the good news is then it can look at lots of different outcomes, easily understood, wide variety of uses, it can give you the best case scenario, worst case scenario, disadvantages, setting it all up. Quite complex, quite expensive. And in the end, it still can't tell you the probability of things happening. It's just, if you put garbage in, you get garbage out.